This is Jody Trana with Chapter 7, Part 1 of Principles of Accounting. In this chapter, we're going to build on some of the experiences we've had so far, doing the accounting cycle from beginning to end. Let's take a look at each one of these steps. Remember that accounting begins with transactions, and transactions are documented on source documents such as checks, invoices, and purchase orders. In accounting, we use the source documents to enter transactions into our journals. Up to this point, we've only used the general journal and written journal entries for all of our transactions. In this chapter, we're going to learn some shortcuts to doing journal entries an easier way. We're going to use special journals, the sales journal, the cash receipts journal, a purchases journal, and a cash payments journal. All of these different journals are going to help us consolidate similar transactions to make journaling easier. Remember that after we wrote journal entries, we posted those entries into our ledger accounts. The only ledger we've used so far is the general ledger. In addition to the general ledger, we can have subsidiary ledgers that help us keep track of things. Two examples are the accounts receivable subsidiary ledger and the accounts payable subsidiary ledger. Once all of our transactions have been posted to our ledger accounts, those accounts can be put onto a trial balance. Then, the accounts from the trial balance are used to create our financial statements, the income statement, the balance sheet, and the statement of owner's equity. The systems that we're going to learn in this chapter are basically a manual accounting system. It's always good to understand how a manual accounting system works. There are some companies who still keep track of their books in manual systems. But it's also very helpful to understand the manual systems because accounting systems on the computer work generally in the same way as a manual system. It's just computerized and keeps track of things in a little more organized and simple way. It may help in following along with the next few slides if you look at this handout all in one place. You can get the handout in Canvas. It is called Handout Chapter 7, Flowchart of Sales and CR Journal. Let's take a look at this sales journal. The sales journal provides a place where we can consolidate all the journal entries related to selling. Here you can see on the left we have the date column, just like we do in the general journal. For each one of these dates, a sale has taken place. The invoice numbers recorded and the customer's name. And then over to the right, we have two separate columns. The first column says accounts receivable debit, sales revenue credit. This is the amount that we are posting that we would normally post in our general journal as a debit to accounts receivable and a credit to sales. It's the total amount of the sale to Maria Galvez on November 2 for the first one. Then over on the right-hand column, we post what would have been our second journal entry for this sale. And all we have to do is to write the cost in here of $505. That ultimately will be debited to cost of goods sold and credited to merchandise inventory. The handy feature of this sales journal is that all we have to do is create a list just like this of all of our sales that take place for the month. Then when we do our totals at the bottom, it's those total amounts that get entered into our general ledger accounts. We do not even do any journal entries for any sales. This is the first new journal that you'll see. Instead of using our general journal to write journal entries for all of our sales, we're going to use the sales journal. Each one of these sales amounts is going to be transferred and posted to our subsidiary ledgers. Let's take a look at each one of these ledgers. On the left, you can see the accounts receivable subsidiary ledger. This is a new ledger to you. It keeps track of each one of our customers and the amounts that each customer owes to us. On the right, you can see a general ledger. We've used a general ledger before. Each time we post from our sales journal, we will post directly into our general ledger accounts. Here you'll see the 4 accounts that we work with when we have sales. We've posted debits to accounts receivable. These are the total amounts from our sales journal. You'll see entries into merchandise inventory for credits to reduce our merchandise inventory. You'll also see credits to sales revenue for the amount of the sales, and you'll see debits to cost of goods sold for the amount of the cost of the merchandise. One of the things that we can do to make sure that we're always posting things correctly is we can do some double checking. Our accounts receivable subsidiary ledger should always agree to our accounts receivable account in the general ledger. Here you can see if you add together all of our subsidiary ledger accounts, Maria Galvez, Brent Harmon, Susan Levy, and Clay Schmidt, each one of their balances adds up to $4,319, which is the exact amount in our accounts receivable account in our general ledger. Now let's look at the opposite side of the handout, at the cash receipts journal. This journal is a place where we can compile all of our transactions for receiving cash into the company. In this way, all of our transactions can be consolidated in this one journal instead of writing individual journal entries in our general journal. Because cash is received for a lot of different reasons, this journal has more columns and more options. But the theory is the same. We're going to record each date of each transaction and the accounts affected each time we receive cash into the company. At the end of the month, instead of posting each one of these accounts individually, we're going to post the totals of each column into each account in the general ledger. On the left side, you'll see again the accounts receivable subsidiary ledger. Each time cash is received from a customer, we will report that in our accounts receivable subsidiary ledger so that each payment received from a customer will show and reduce their accounts receivable balance. Over to the right, you can see all of the general ledger accounts that were affected by this month's transactions of cash receipts. Let's take a look at how these journals and ledgers work. Let's assume on June 1 that we sold merchandise inventory on account to Finn Jolly for the amount of $1,220. The cost of the goods was $990 and our invoice number is 101. You can see that we've entered everything into our sales journal, including our terms. We could have different terms for each customer, so it's good to write them here. The second step is to record that invoice in Finn Jolly's accounts receivable subsidiary ledger. This helps us keep track of how much money this particular customer owes us. Once we've posted the amount to our subsidiary ledger, we'll put a check mark in the reference column for Finn Jolly. The second entry is for June 8, when we sold merchandise inventory on account to Ida Foster for $2,075. The cost of these goods was $1,630, and our invoice number was 102. You can see that the terms are the same. We will post this June 8 sale in Ida Foster's accounts receivable subsidiary ledger. This way that we will know how much is owed by this customer. You'll notice that in this reference column, we have put S1 for the sales journal, page 1. Back in the sales journal, we will put a check mark for Ida Foster to show that we have posted that in the subsidiary ledger. Next, we have a sale on June 13 where we sold merchandise inventory on account to Joy Tree in the amount of $420. The cost of these goods were $250. The invoice number is 103, and the terms are the same. Just like we did with Finn Jolly and Ida Foster, we will post the $420 that we expect to receive from Joy Tree in this customer's accounts receivable subsidiary ledger. After putting a check mark in the reference column beside Joy Tree, we will enter our final transaction for June, where we sold merchandise inventory on account to Grace Wright in the amount of $830. The cost of these goods were $560, and the invoice was $104. Our final entry into the subsidiary ledgers is invoice number 104 to Grace Wright for $830. Here's where we get our reward for doing our sales journal. We don't have to do any journal entries at all. We just need to total each one of the columns, and the header on the column tells us exactly which accounts to post these amounts to in our general ledger. The $4,545 will be posted as a debit to accounts receivable and a credit to sales. The $3,430 will be posted as a debit to cost of goods sold and a credit to inventory directly into the general ledger accounts. Here you can see our entries into the general ledger accounts for accounts receivable, $4,545 with a reference of Sales Journal 1 or S1 and a credit to sales revenue for the same amount. Notice the account numbers. Accounts receivable is account number 112 and sales revenue is account number 411. Once we've posted those amounts to our general ledger accounts, we will make that reference on our sales journal right underneath the total number. So under 4,545, we will enter the two account numbers on our account ledger, 112 and 411. Now we'll post the $3,430 to our cost of goods sold and our inventory general ledger accounts. The amounts we post here from our sales journal will decrease our merchandise inventory balance since we're crediting it, and will increase our cost of goods sold balance. The account number for merchandise inventory is 118, and the account number for cost of goods sold is 511. Those two accounts are used as references for our column of cost of goods sold and inventory to note that we posted those to our general ledger accounts. We're going to look at all of the entries into our cash receipts journal here at one time. July 5 represents merchandise inventory that we've sold for cash. Every one of our entries into the cash receipts journal is going to have something in the cash debit column. And then you'll need to identify what the credit is. When we sell merchandise, we'll also use that far right column that has a cost of goods sold debit and an inventory credit. On July 7, we received $822 from Grace Wright, which is in full settlement of her accounts receivable. She earned an $8 discount, so you can see here that we're going to be debiting cash, we're going to debit sales discounts, and we're going to credit accounts receivable. Because this is an accounts receivable account, we'll also need to post this in our accounts receivable subsidiary ledger to show that Grace Wright made a payment. On the 18th of July, we collected interest revenue of $2,100. This isn't a normal amount that we would receive, so we don't have a specific column for it. We're going to put the debit in cash and the credit is going to go in our column for other accounts. You'll notice that we've written in the name of the account right beside the date of interest revenue. On the 29th, we received money from our customer FinJolly in the amount of $1,220. That's payment on account. They did not receive any kind of a discount, so we're just going to debit cash and credit accounts receivable for the $1,220. This amount also will need to be posted to our accounts receivable subsidiary ledger. Here you can see those two postings to our accounts receivable subsidiary ledger for the amount that Grace Wright and FinJolly paid us in July. Because we've posted to our accounts receivable subsidiary ledger both the amounts for Grace Wright and for FinJolly, we will make some check marks in the reference column to indicate that we posted those. We're also going to post the balances from our cash receipts journal. That would be a debit to cash for the total amount in the month of $6,442. You'll see our reference is the cash receipts journal, page 1, and the accounts receivable that we received of $2,050. Notice that the cash account number is 100 and the accounts receivable account number is 112. At the bottom of our cash receipts journal and at the July 18 reference column, you'll notice the account numbers that we used for each one of our postings that we made into our general ledger.